How can you make a charitable contribution, make a difference in the world around you, and realize a tax deduction all at the same time? Hi, I'm attorney Karl D. Shehu, the founder and managing member of Shehu Legal right here in Connecticut. And today we're going to talk about what is known as a charitable remainder trust. Now, a charitable remainder trust is an often overlooked type of tool that is used in estate planning. Now, the benefits of this estate planning tool is that it can allow you to make a difference in the world around you by contributing to causes that are important to you, while realizing a charitable deduction on your tax returns all at the same time. Let's take a look at how it works. So the donor, the person who is making the contribution to the charitable remainder trust, will place that contribution into the trust. And we represent the trust, of course, as a bucket. That really is essentially what a trust is. It holds the assets for later dumping out or distribution to someone else. And so once the assets have been deposited into that bucket, that charitable remainder trust, they are invested. They're put to use, and they're typically invested into securities. And the idea is to get a flow back and increase the amount of assets that exist within that charitable remainder trust. So during the life of the donor, or for a set term of years, and the term of years cannot exceed 20 years, that donor will receive periodic distributions from the charitable remainder trust. And those distributions can occur on an annual basis, or they can be more frequent than an annual basis based on the terms of the trust. And then upon the death of the donor, whatever remains in that trust will be contributed to a charity of the donor's choosing. Now, one of the common concerns that I have seen with people in regard to charitable contributions, a person may decide their children are out of the house, they've paid for college, they realize that they have a significant amount of wealth, more than they can spend in his or her lifetime. But there's a certain fear that comes from just giving everything you have to a charity. And it's that once you've made a gift, you can't take it back. So a person doesn't want to put himself in a position where he's made a contribution to charity, he's enhanced the lives of other people or a cause that's important to him, but he's made himself destitute in the process, or he put himself in a position where he's struggling financially. That is the biggest hang-up about charitable contributions. A charitable remainder trust solves that concern. It works similar to any other trust in that there are essentially three parties to the arrangement. What is a trust? Think of a trust as a bucket. One party, known as the trust maker, takes his assets and places them in trust, in the bucket. He hands that bucket to a second party, known as the trustee. The trustee holds the donor's assets in trust for the benefit of third parties, known as the beneficiaries, and he pours those assets out at a time specified in the trust document. With a charitable remainder trust, there are two classes of beneficiaries. There's the life beneficiary, that is the person that is receiving periodic payments from this trust for a term of years or for life. And then we have the death or the remainder beneficiary. And this must be a charity. So this can be any type of charity of the donor's choosing. So let's talk about taxation. So when we talk about taxation and there's a trust involved, we're always concerned with taxation on really two different levels. Taxation for the individual involved, the donor, the trust maker, and taxation related to the trust itself, because a trust in some cases can pay a higher tax rate than what an individual would pay. When a contribution is made from the donor or the trust maker to that charitable remainder trust, that contribution is totally, and I will put an asterisk next to that for a second, but in most cases, totally tax deductible. So he can write off whatever that contribution would be. Okay, and now you might be saying to yourself, well, what is the hang-up? Is the trust going to realize a significant amount of income from that contribution? And the answer is no. The donor, the person who is making the contribution to the charitable remainder trust, whenever he does that, in the year that he makes the contribution, he can realize an immediate tax benefit through a tax write-off, a deduction. And the trust itself, the charitable remainder trust, pays no taxes on income or capital gains. Well, why is that? Well, you see, the IRS looks at a charitable remainder trust as a type of charitable entity in itself. So you might be asking yourselves, well, is this true with any type of trust? And the answer is no. You see, a revocable living trust, what most people commonly think of in the estate planning context as a trust, affords no immediate tax benefit for the grantor or the donor. And the reason for this is because a revocable living trust is obviously revocable. So the donor at any point can change out the beneficiary. If the donor were to make a contribution into a revocable living trust, he could easily just list a charity, and then after the contribution is made, he could remove the charity and put his son in there. And so the IRS realizes this can occur, and they say you don't get a tax deduction even if the beneficiary of your revocable living trust is a charity. A charitable remainder trust, on the other hand, is not revocable. It is irrevocable. And so once the assets are given to the trustee by the donor, those assets will be given to a charity at some point. Now, in many cases, the donor can reserve the right to substitute out one charity or another as that remainder beneficiary. But remaining assets have to end up in a charitable contribution. All right, so you're probably asking yourselves, well, what about that life beneficiary? That must have to be a charity, right? The answer is no. In fact, the IRS says that that life beneficiary, at least one of those life beneficiaries, there can be multiple, cannot be a charity. And typically what we see is the donor lists himself as the life beneficiary. This is one of the only instances where you can actually receive an income from a charitable contribution. Let's take a look at that. Let's say you have a bunch of appreciated securities. You've done very well on the market. Well, we know that with the way stock works is when you sell it, you realize what is known as a capital gain. And a capital gain is the difference between what you purchased the stock at and what it is at the time you sell it. So let's say you have a bunch of these securities, and instead of selling them and realizing that capital gain, you contribute them into your charitable remainder trust. Do you have to pay capital gains taxes? No, you've made a charitable contribution. But what you've done is you funded that charitable remainder trust with stock that increased in value. And now that stock will continue to accumulate through that charitable remainder trust, and you will receive periodic payments. So you are receiving a benefit from stock on which there was a capital gain, and you are not subject to capital gains taxes. What are the drawbacks of this? Well, the trust fund itself can be somewhat volatile because it's being invested. So it's important that whoever that trustee is that is appointed by the donor, it's important that he has advice from a competent financial advisor, someone who really knows what he's doing to make sure those assets increase and not decrease. So are you charitably inclined? If so, when you talk with your estate planning attorney, don't forget those 3 words: charitable remainder trust. I'm Karl D. Shehu. Thanks for tuning in. Take care, memento mori, and God bless.